This is Chris Thorpe in New York, joined by Andy Furman, who is in Houston, Texas. Thanks for joining session 7, which is risk mitigation and price risk management in oil markets during this period of COVID-19 in 2020. I'm going to jump to my screen share here to start the presentation. Just starting off quickly with legal disclaimers. Very quickly, this is for information only. There is no suggestion of any trading strategy that for you or your company. That would be customized based on a lot more information. If you need recommendations, please feel free to reach out to me or Andy.
Past performance is no indication of future results. We're really glad to be here today. Thanks for having us, Chris.
Well, just give you guys a bit of background on us. I'm Chris Thorpe. I'm a chartered financial analyst. I've got over 25 years in oil, gas, petrochemicals, and energy finance and risk management. I advise corporate hedging clients and high net worth clients. I also am a principal equity investor in middle market transactions. Andy?
Yes, my name is Andy Furman, and I've been involved with commodities since 1985. And we've been advising on hedge programs at R Squared since 2008. We've got over 40 clients. Some are in the S&P 500, and others are utilities and E&Ps, end users, producers, private equity.
Okay, thanks, Eddie. Well, look, we're going to start out by just talking about 2020. Well, clearly, COVID-19 struck almost immediately after the Russians and Saudis announced a price war. In fact, at one point, at least in the aviation market, commercial flights were down 40% below their peak January level, and international flights were down by 86% by June year over year, which is quite incredible. Global transportation markets were coming to a halt, both on the road, certainly aviation, and eventually on the marine side as well. And look, the overall impact was multifold. The price collapse in oil, of course, was worse than the second half of 2014, certainly well beyond bearish forecasts, and spot futures fell below zero, believe it or not. You probably saw that. We're going to touch on that later. And we had an interesting situation in the futures market where the front months collapsed quite dramatically while the back months did not collapse as much. And the result of that was really folks that had inventory in their tanks were hit pretty hard and had to take write-downs. But it did also allow folks that had empty tanks to load up, fill those tanks up, and lock in some profits by hedging in the future. But eventually storage filled up very quickly. You probably saw in the marine markets that freighters and any empty floating storage was filled, and the price of that storage went up quite quickly. And there was a scarcity of storage in the market. And of course, overall, global interest rates fell when central banks intervened, which really propped up markets very quickly, infusing the market with liquidity, which continues to this day. Andy, do you want to touch on world oil demand?
Sure, Chris. Using 100 million barrels per day as a benchmark back in 2019, we've seen about 8 to 9 million barrels a day in loss on average for the whole year. It's actually was actually below. I think we lost at one point about 25 million barrels per day, but now we're climbing back. And the key thing here is that the markets are always forward-looking. So we're looking at 2021, and we've got on the chart 97 million from the IEA in terms of what their expectations are for demand. The thing for us is that we don't think that number will be hit. So what we want to be watching for is when the demand numbers actually drop. And so we're going to be watching the relative change and the adjustments on a future basis for that demand.
So one thing that happened between March and April were was that in this example, in ULSD markets in dollars in dollars per gallon here, from March we fell dramatically from about 120 per gallon down to around 75 cents per gallon in the front months, dropping dramatically, not so much in the back months. This increase in the spread magnified the contango structure of the market and allowed folks with storage ability to buy product, put it in tank, and then hedge out into from the April period, hedging out into the later part of the year and capturing a risk-free profit. But you had to have the storage ability to do that. If you didn't have the place to store it, you couldn't do that. But let's talk about what happened, Andy, between then and now.
We had a cut of 9.8 million barrels from OPEC, and together with producers in the United States, with U.S. shale cutting back as well, the market's been able to recover in price.
And you can see in this chart that the red dotted line is now less steep. So we have that purple line that was very steep in March, April, May. It's really rebounded. So we have a very flat curve now, and it's really, there's no contango left in the market. So buying and putting in the tank and storing and hedging out into latter part of the year doesn't really make any sense. So there's no free lunch now in terms of an arbitrage trade.
Andy, what about that one-day negative event?
Well, the important thing to remember is that even though this is a one-day event where we had the news headline, it really took place over a good 4-month period, because you had the Saudi IPO back in December, and then COVID coming through in January with China, with, you're starting to see some airline demand loss, and then the price war between the Saudis and the Russians. So, in March. So the storage was already being spoken for before this big drop in price in April. The important thing to know, Chris, if we can go to the next slide, is that the industry price was $16.70 for the whole month, and the industry isn't really trading on a single day. Hedge funds can trade for a single day's price. They can capture everything, but for a producer or a consumer, it's very, very hard to get that single day's price. In terms of the mechanics that took place that day, we had a lot of things going here. We had there were ETF, the USO ETF was long contracts in the front month, and they had to roll. We had speculators. The open interest was about 50% higher than it should have been, on an average basis.
Yeah, it's interesting because although negative oil prices, or at least zero price crude oil in the futures looks like an attractive buy, when these big funds are rolling, or there are industrial hedgers trading their positions, the retail investors can get caught in a very, very bad position, which is what happened. I believe that this is probably the first time in history this has happened so dramatically. And if you want to read the play-by-play of what happened that day, please click on this link and read the story that is well documented by Bloomberg. And let's just talk about risk in a broader context and what hedgers can do now for the rest of the year. I just want to note something that I find quite amazing right now, and that is that in terms of the general financial markets, the S&P 500 is, I'd say, well valued or potentially overvalued, especially at the large company size. You can see here on this slide that companies in the over $800 billion, approaching $1 trillion, are trading at over 30 times price to earnings ratio, while smaller companies, when I say smaller, I say 5 to 10 billion, are only trading at 13 to 14 times earnings. So there's a dramatic disparity between very large companies and small or medium-sized corporate companies. And even on a cash flow basis, the disparity is quite amazing. And I would argue that this indicates there's a lot of risk in the market and turmoil in the future. Now let's put that in context with the oil market.
So what we're looking at right here is called the oil expense indicator. Instead of pricing crude oil in dollars per barrel, why not price it in the costs to the world? So what we're doing is we're looking at the number of barrels, for example, 100 million barrels per day or 92 million barrels per day. We're multiplying that times the price of oil times 365 days in a year, and we're dividing that by world GDP. And then what you're left with is a percentage. So here on the chart, we can see that typically, going back to 1983 when oil trading started, that you're going to have a range between, let's say, 1 and 5%, and that 1.5% cost, very, very cheap for crude oil, 4.5% expensive for crude oil. So if you're a producer, you want to be looking at that 4.5% level, and you want to be very, very aggressive, and you want to extend your duration. On the other side of that is the consumer. The consumer, when the consumer sees that we're down at 1.5%, they should be thinking about ways that they can be buying more crude oil.
Yeah, and with that flat curve right now, consumer hedgers really have the opportunity to take advantage of what looks like a low price environment right now if they're hedging out, say, for the end of the year or into next year.
Absolutely, and that's a great way to extend your duration.
Now, from a marine fuel hedger perspective, let's call it trader or those that are consuming marine fuel. How do you look at risk from here out?
Okay, so what we typically do for our clients is that we break out risk in terms of looking at the black line for historic settlements, the black dash line for the forward futures curve, and then the first bands of green and red are for the 25% up and 25% down, and the darker green and darker red on the up and the bottom are the 5% worst case and best case. So if you go on to the next slide, we can actually see those outcomes. Okay, the point here is that if you take a look, for example, at the 50% bands, there's an equal chance that you could be above or below. These are pretty accurate predictors of risk, meaning that the risk numbers that you're going to see in the first 12 months, they can and will happen. And it's actually in years 2 and years 3 where you see risk that is actually exceeded, meaning that if it says it's a 5% chance of happening, it actually happens greater than 5% chance, a 5% chance, and likewise for the downside as well.
So look, are you prepared for the next volatility event? I have a way that you might start preparing now, and it's to read a brand new book that's launched by Andy and his partners. Andy, can you talk a bit about risk as an asset?
Sure. Okay, so most of the literature that's out there, most of the books that are out there are discussing derivatives hedging, meaning like what's a put, what's a call, how do I hedge with a futures contract? Okay, from our perspective, that doesn't really address how you achieve success with hedging. So this book is about enterprise hedging. It talks about meeting budget. It talks about having enough hedges and quantifying those hedges and getting the right size of the hedges so that you can have all the upside that you can afford to keep.
So I encourage everybody to pick this book up. It's also available on your Kindle and ebooks and wherever you buy books. So we thank everybody for coming to the presentation. Both Andrew and I are available in the chat rooms later. You can also reach us by email, of course, and we look forward to speaking with you guys very soon.